What split of cash down, finance, and earnout should you be using when structuring your online business acquisition? Hi, I'm Jaryd Krause. I'm the host of the Buying Online Businesses podcast, and today I'm speaking with Chris Guthrie, who is a sales side online business M&A advisor for the broker QuiteLight, which I'm sure you'll know. He's bought and scaled his own online businesses from content sites, e-commerce businesses, and SaaS businesses. And in this podcast episode, Chris and I talk about why he started getting into online businesses, how he started a few of his own online businesses, how he's bought some of his own online businesses, and also what types of online business models he likes, and if he was to acquire again, which ones he would prefer to have and operate. We also discuss some of the due diligence stories and mistakes that he had made so that you can learn from so you don't make the same mistakes. We talk about advice he offers buyers on the buy side, also advice he offers sellers when they're trying to exit a business. We also go through some common deal structures from financing, cash down, earnout, holds, notes, and all those sorts of things, and what can come into play for a seller and a buyer when making those payments or deal structures, and how you need to consider both sides in the deal. We also discuss the state of the market, multiples, and how other markets can change our market, and often do, and have massive changes for us. Talking about maybe the best time to acquire businesses, and I think we're in a good period personally. We also talk about what the most successful sellers have in common that Chris has noticed when he's been working with entrepreneurs exiting their business. Now, we talk a lot about buying businesses and selling businesses. If you don't have my due diligence framework, it takes the guesswork out of how to buy a business. It's what I use, it's what my clients use. It's helped me make millions of dollars, help others save and make millions of dollars. And you can get it at buyingonlinebusiness.com/free resources. And there's a link to that in the description as well. Now let's dive into the pod. Do you have a website you might want to sell either now or in the future? We have a hungry list of cashed up and trained up buyers that want to buy your content website. If you have a site making over $300 per month and want to sell it, head to buyingonlinebusinesses.co/sell your business, or email us at info@buyingonlinebusinesses.com, because we will likely have a buyer. Details are in the description. Chris, welcome to the podcast. Thanks for coming on.
Yeah, thanks for having me.
Looking forward to chatting. Now, typically I don't do like a hero's journey story, but I do want to ask you, why did you get in, how and why did you get into the space of buying online businesses?
Yeah, I can go pretty far back, I suppose, if it's interesting.
Yeah.
But I started initially with building from scratch because I just had literally no money, and so I was writing everything myself, creating the content, updating the plugins. There would be a few things like WordPress themes that I would try and contract out, but ultimately I had a website that was very niche, focused on like a obscure area in video games. And I got my first I saw my first like $1 or $2 in AdSense earnings, and I was like, oh man, if I could just get more traffic, then I could make this like a full-time thing. So that was what, just that first kind of dollar online is what allowed me to be like, okay, I can see there's like a path to go forward. And then from there, just built out some sites, did well, and then ultimately I lost my day job and took the earnings from my full-time site and was able to just do that moving forward. And then ever since then, it's been about 15 years or so, just doing different types of things, content, e-commerce, SaaS. And then I sold my last business and have been helping people advise on their sales. So
yeah, I want to dig into the sales and sales advisory soon. What was the intention? Like, what was your motivation to build something online outside of your day job?
yeah, I mean, ultimately I was really like I liked my job. It was okay, but I just really wanted to be my own boss. That was the main kind of motivation, just having more freedom to do what I want to do during the day and kind of be able to be compensated based on my results rather than, what you might typically see in a day job. Although, you can see there are some jobs that they can help compensate in that structure. But that was the main thing, was I wanted to just have more freedom. And so that was kind of the path that I went, was to do it that way.
Yeah, cool. So started 15 years ago. Now, do you still acquire, do you own any businesses other than your sell side M&A advisory at the moment? And do you buy them anymore, or?
Yeah, I had a lot. Like I had a lot of different things. I've had e-commerce business, SaaS business, a portfolio of content websites, but ultimately I sold everything off just because I wanted to focus solely on advising, and also just to kind of free up more time. More time. So I don't. Yeah, every advisor, they kind of do different things. I like to fluctuate between periods of working a lot and periods of just taking time off. And like earlier today, I was at my son's field trip, and so that was that was kind of the approach, I guess. But yeah, it's been a little while since I bought, but I, of course, whenever I talk to people, I hear what they're doing, and it always interests me, and I always think maybe I should get back into operating at some point. But for now, still enjoying advising and not looking to do that at this time.
Yeah, I definitely hear you. Like, I went the same route as well. I bought 3 businesses in 3 years and thought I just need to just keep buying these businesses to add all these income streams in, and found that like it just takes up so much capacity. And being young, I thought I'll make it work and crush it with all of them. But it just you do just end up dropping the ball on some, for sure. Hey, and it's like you're just not doing justice to each of the businesses when you could be serving at a better level. I used to think you could serve at scale through multiple businesses, but like if you just do put all your capacity into one, it's far better for everybody involved.
Oh yeah, yeah. I mean, I can definitely speak to like my lived experience is definitely in line with that as well. Like, I mean, I spent so much time. I'd find new things, and I would start up a new business, or I would buy something and try and build. And what I found is even when I hired full time, like a full time employee and contractors to help out, it still just was really hard for me to align the team around what to focus on, because it'd be like, okay, we've got this WordPress plugin, it's a premium WordPress plugin, we can work on that, and then we've got these content sites over here, and then the SaaS business, and then also this e-commerce business, and it really just became like too much. That was like my peak in earning, and so there was an advantage to all that. But ultimately, what I found is that the businesses that I didn't focus on slowly started to suffer, and the ones I focused on most started to have better results. And so, yeah, I think for me, and I know maybe everybody's different, but I do think like just focusing in on one thing is my preference. So if I were to get back into operating and I were to buy something, I would just buy one and just work on that. I think it's really hard to remove yourself fully. Um, but I do see it from time to time when I talk to people, but it's less common.
Yeah, you've got some people that are just great managers and they're just built for that. It's a small percentage of the people though, I believe, typically. So content, SaaS, ecom. What was your favorite business model and why?
Yeah, I mean, I could say there's I have multiple reasons for why I like each thing. I mean, I think that for an e-commerce business, it's fun to create something like real world and physical and tangible, that you work with a supplier to create something that people like, and you listen to feedback to improve and iterate, and it's something that's actually exists out in the world. Um, and that's fun. But then you're dealing with Amazon and other types of marketplaces, and that can be kind of a pain sometimes. But again, it kind of goes back to like that focus. I wouldn't think I'd be able to do e-commerce and then content, because you've got to focus on the changes on Amazon, for example, or Shopify, or paid advertising channels. And then on the content side, you've got to focus on SEO and everything else as well. So um, I do think that content was probably what I enjoyed the most. But SaaS is a close second. Um, the downside with SaaS is that, at least for me, I'm not technical, so it's like a path where you pretty much have to have people you hire or a business partner, which depending on how your results go, that can be good or bad, or you can have kind of you give up a little bit less control, right? But with content, it's like you're creating content, you're hiring writers, and you're working on trying to serve your niche best. And so that's something that I could do fully without anyone else being involved, and so that's something that is pretty nice as well. So it's kind of a tough toss up. I'd say content or SaaS. If I were to go back to operating, it'd be one of those two.
Yeah. So one of those two would be like if you just buy one and it was just to be like say your dream business, it would be one or the other, content or SaaS. Yeah. Okay.
Yeah. I mean, and then of course there's pros and cons of the operating, right? So, with content, you're more at the whims of Google. With SaaS, again, you've got to focus on competitors and being able to make sure you are continuously releasing new features, and so you're managing that side of the things, and you're working with customers and doing that as well. And there's more sales oriented. Whereas with content, it's not like that, right? It's more passive in that regard, I guess, in terms of how you actually run the business.
Totally agree. I totally agree. And it's a slower business to run with content or media business than a SaaS business, I guess. When you've got big pockets of other companies that are competitors that can come in and just swallow the business or just acquire that market share pretty fast. So being on top of that is very important. Now, so did you started some content businesses? There's the ecom and the SaaS. Did you start those or did you acquire those?
Most of what I've done has been start from scratch, but I have bought content in particular. Content's probably what I bought the most of. Um, but e-commerce, I started that from scratch, and then SaaS was also a start from scratch. But happy to talk about either one. Content in particular, uh, once you've run it, it seems like there's easier to find avenues to grow. So like I bought a site in the military space for $250,000 with a friend of mine, and we worked on really just like the main thing was just swapping out ad code, switching it from AdSense to AdThrive, and like getting an immediate lift. I think it was about maybe 30 or 40%. We ran it for a while, and it was like, why are we? This is too small for us to both focus on, and maybe it could be much bigger business if one of us really dove into it. But we ended up selling that later to someone that just had an inbound inquiry that was in the military or ex-military, and they wanted to buy that site. So
Cool. Congrats on the sale. So, what I'd love to know what sort of like were the lessons that you've learned through, or some of the tough lessons that you've learned through the acquisition side of these content sites? Like, what are some of the like, you have a horror story or something that, our listeners can learn from, I guess?
yeah, I mean, one of the first content sites I bought was in the gardening space, and it's trying to remember if it was like 2015 or 2016 or something. It was a long time ago. It was one of the earlier buys that I did, and I started with smaller sites to begin with. That site I bought for I think it was $10,000 or $12,000, something like that. And when I bought that site, I negotiated a structure where the expert, the one that had been running the site, he was going to finish creating some content for me, but it was to occur, after the sale and after I already paid him. And so I was an amateur at the time, and you might see where this direction is going, but essentially he never delivered on that content that was created. So the mistake was don't try and assign additional work for someone to do post sale unless there's some sort of a structure that holds them to it. Or whether it's a holdback or earn out or something like that can be attached to work being completed, or for it to be big enough for legal action to be a path to make sense, right? With a sale like this, it makes no sense to go and try and pursue an attorney to try and go after it. It was more just like, oh, yep, I should have said, hey, I'll give you another $1,000 if you do this, or 2,000 afterwards, and didn't do that. So that was one of the like early mistakes I made. I also can give you others. I had a site that I bought for I think it was $2,000 in the merch by Amazon space, and I bought that because I thought about building a software tool for merch sellers. And I thought, okay, this would be a channel of traffic to drive people to. But ultimately, I started spending more research in going down that path, and I thought ultimately this doesn't feel like the right niche for me. And so it was just sort of, and the problem with this site was, worst case, I could keep running it, but the issue was it was very heavy on private advertisers. And so with private advertisers, oftentimes there's a relationship component. And when you take over a site as a new buyer, it's hard for those relationships to transfer sometimes. And so I didn't keep up those relationships, again, because it was kind of a smaller site at the time for me. And so then some of that private ad money started to go away. And so that was kind of ended up being a zero. But yeah, so those are a couple examples, but I'm sure there's plenty more I could come up with.
Yeah, no, that's great. Thanks. Yeah, it's always good to have a good structure in place to hold the seller accountable if there's deliverables to, that you need, that you're waiting for and that you need. Even if there's not, it's just nice to have an earnout or a seller note that has the seller still bought into communication and support throughout the deal. You talk to a lot of buyers and a lot of sellers. What's the most typical structure that you would see for, I guess for maybe two different price ranges?
Yeah. Well, most of what I'm seeing now for the businesses that we sell are larger, usually six figures on up, and the structures definitely vary a lot once you get up into the larger sales. With something that's around six figures, oftentimes, since I'm trying to advise the seller and I'm trying to represent their interests, I'm trying to push for all cash at close and making it simple for them. But some buyers kind of push back and they want to have certain types of milestones. More common scenario though is like I had a deal where it was a multi seven figure deal, and in the case of that business, the buyer structured a deal to keep the original owner continuing to create content and working on the website, and then additionally they paid above the multiple that we were asking, so they could do some as an earnout. And so there was two different earnout payments, each one a seven figure earnout payment for each one. So first year and then the second year. And so ultimately though, she received both those payments, and really happy with the outcome. But oftentimes with the sales that are in like the lower six figure range, it's usually just kind of all cash at close is what I try and push for the sellers.
Understandable, definitely understandable. When you've got like this deal, you said multiple seven figures, and you had two earnout structures. What amount did they pay in cash, or was it finance that they paid? And then what amount was the earnout, and how long did that earnout last for?
Yeah, it was roughly 70% or 60% cash at close. And then the earnouts were around 20% each for those. So it was pretty hefty on the back end, but the earnout was pretty achievable for the buyer. I can't remember the exact terms because it was a few years ago, but ultimately those were both met. I think the challenge, if you're on the buy side and you're trying to protect your interests, then um, setting a structure that's on top line revenue is usually what I recommend, because every buyer is going to want to run the business differently than another. And so some might want to be more profitable, others might want to try and dump a bunch of money in and try and grow it as quickly as possible, or reinvest heavily. And so the best metric is to just go with something on top line revenue, and then make sure you give access to AdThrive, Raptive, Mediavine, or any other types of these platforms that are primary revenue channels, so that way they can see, are they hitting those revenue numbers or not. Yeah, so that's kind of what I would say from like the best way to structure the earnouts. But in terms of how much you might assign to an earnout, that really can vary by deal. That one was, I would say, more of an extreme example. More often, I see earnouts that are 10 to 20%. So that was quite a bit more.
Yeah, I agree. It's definitely dependent on so many things, not just the deal size, but the buyer and the seller, um, and the agreements as well. It's not just about the money, that's for sure. Sticking with the theme of money in the deal, though, you say an earnout structure around the top line revenue. Are you talking about, with this instance or as an example, ones that you've seen in the past, is like how much the top amount of revenue they have at an average payout once it hits that, or a little bit less on the earnout if it is less, or more if it's more? How do you normally see that play out?
Most often, it's like, okay, as long as the revenue meets this specific threshold, then you'll be paid out this
Yeah,
amount. Sometimes the earnouts can be more complex, where they'll have tiers. So it's like, as long as you meet this much, you'll get paid the full amount. If you meet, some degree below that, then you can get, 75%, that type of structure. But more often it's just like a hurdle rate, where it's like, this is the mark that needs to be hit. And as long as that's hit, then the payment is made. Something that sellers want to have sometimes is they'd say, hey, look, can we have that money sitting in escrow?
mm,
But buyers usually don't want to do that, because the reason why they're doing that structure in the first place is because they're trying to reduce their cash at close. Is they're trying to not only minimize the risk, but also they want their money to go further, because usually they're maybe making more acquisitions, or they want that capital to be available for any other thing. And so that's the more common scenarios, that you're going to have a little risk there. I usually tell sellers that to be okay with, in the worst case scenario, just receiving what you receive as cash at close, And if you're okay with that, then you can proceed with the deal. But if it feels like it's too small or there's issues there, then maybe that's you're gonna need to push for more cash at close and a smaller earnout.
Yeah,
Um, but yeah, I mean, I'd say that sub 1 million earnouts are less common.
absolutely.
Above 1 million, there's some sort of holdback earnout, some sort of structure that usually tends to work its way in, but it just depends.
Mid seven figures and up, what sort of, or is it a different price range? When do you start to see mostly it's just finance and not too much sort of skin in the game? Maybe it's 5 to 10% of cash from the the buyer. What sort of like price range do you see that happening?
I mean, the more common scenario when a buyer's putting down that little amount, it would be when they're doing like an SBA loan. So if you're doing an SBA loan to acquire a business, then you can put as little down as 10%. The business needs to be pre-qualified for SBA, and not every business is. Generally, it requires the business to be U.S. based with U.S. tax returns, and then the buyer also to be U.S. based. Although I don't think I've had an international buyer acquire, but that's the most common scenario. Is you've got U.S. based business, U.S. tax returns. The last 3 years of tax returns you provide to a lender. There's a bunch that I've worked with over the years, but they'll look through the tax returns, look at the P&L that's provided, and then look to see if that can be pre-qualified. And yeah, buyers can end up buying with 10% down. I had a content site for 1.2 million, and the buyer put down just 120 grand to buy it in the food space. So that's another path that can be happen. But I've not seen buyers where they're putting down that little, and then there isn't some sort of loan that's paying out the seller at the close, right? Because with the SBA loans, the buyers to them they're just putting 10% down. They've got a 10-year note. They're paying on that over time. But for the seller, they're getting all that cash at close, and so that's a more common scenario.
Absolutely. Now, I mean, sometimes I presume that you need to educate some buyers, right? This is my biggest job and task, and helping them become savvy buyers and making it easier for brokers to work with, right? Asking less questions, having good communication, all those sorts of things. I will ask about on the sell side as well as some of the education you provide them. But what are the top 2 to 3 things that or things that you advise on or share that is advice to buyers that they just need to know about when they're coming into an acquisition?
Yeah, I mean, I think the main thing that I usually try to get my sellers to provide is like directions for growth opportunities, that type of thing, so that a buyer can have some sort of a playbook or a strategy to take the business once they go moving forward. We represent sellers, and so we're focused on their outcome. But I also recognize that the buyers are gonna you need the buyers to be able to get a transaction to go through. And the best case scenario is that everyone walks away happy with the deal. And then sometimes you have buyers that come back. I've been doing this work now for 5 years. And so you have buyers that come back when they've grown the business and they want to sell it later. And so you can help them sell it a second time. And so usually it's around like, what would you do after you sell? What could someone else do to grow it? And that's usually what I try to get the sellers to focus on, providing as much information about that, and then that way the buyers kind of know. In terms of the rest of the stuff that they're educated on, it's usually around like I will get a lot of people that try to buy businesses that want to do like a very small amount down, like 5 or 10%, and I have to kind of describe how that doesn't work as well for these deals. Um, but it's more common that you're trying to give them advice on what they can do to operate moving forward. And I'll share from my experiences as well, running and give advice in that as well.
Yeah, I've definitely noticed that people have come in with these ideologies of let's buy a business with no money down and having to explain with like the size of the acquisition that you want to go for, especially in the online business space. This is different to offline or brick and mortar, is that the market just doesn't allow that because somebody's going to come in with cash at that price range and just purchase that business. So you need to understanding the market and where the market is at is important. Before we got on the call, you mentioned about e-com businesses and multiples and stuff like that. Talking about the current state of the market before we dive into like the education on the sell side. How have you seen multiples fluctuate in the last sort of 2 years? in those three different, I guess, asset classes: media being blogs, content sites, membership, SaaS businesses, and then ecom.
Yeah, I'd say that multiples seem to be down slightly compared to like 2021 was a high water mark, primarily because there was just that was like the peak COVID money stimulus and zero interest rate environment, and everyone just kind of buying. Like I had a $10 million deal for an all cash buyer, for example, which is just less common. Um, and so, yeah, I mean, that was like a crazy sale that I realized later I don't think would have happened if it happened in 2022. And then, yeah, 2022 was pretty soft because that was when interest rates started to rise. And, of course, it makes sense in hindsight, but, you know, I didn't realize just how much of an effect those interest rates from the Federal Reserve would impact even buyers that aren't using loans, that are just paying with cash, because the cash becomes more expensive, right? Because you have a hurdle rate you've got to exceed to get over what these new interest rates are at. But in terms of multiples, I'd say that they're a little bit softer than where they were, maybe 10 to 20% lower. And I can give you some examples. So, like in e-commerce, there was a lot of money buying FBA brands, and from aggregators that have raised hundreds of millions of dollars to buy brands. Um, they didn't do as well as they had hoped they would after acquiring those brands. And so when there was this buy pressure from these hundreds of millions of dollars that were raised, that was helping to push up multiples and improve close times and just kind of get sellers better deals. But then once that buy pressure is removed, then of course the multiples have to drop a bit. And so that's kind of an example that I've seen in the e-commerce space. But there's also definitely fluctuations just in like how the business is running, right? So if the business is in decline, which I do see more of those now, as opposed to the businesses that are flat or growing, whereas before I would almost always see just growth, that also has a negative impact on multiples. So I'd say it's the multiples themselves are probably more having to do with just the businesses and the owners that I talk to, with their results not being as good, and maybe less, so to speak, with just the overall multiple being lower. I think it more has to do with just the results aren't as good.
Yeah, it's thanks for that. Thanks for that share. I've definitely noticed multiples being down since 2022, and I think I think a lot of people that don't understand how markets work or haven't yet like sort of gotten their finger on the pulse with it, which is me back in the day. I had no idea. But when you're in the market, you start to see, or when you've seen market fluctuations, you start to see how they work in terms of like when there's stimulus, when different interest rate environments that has nothing to do with, say, an online business or an offline business. It could just be having everything to do with like the cash rate, the interest rate at the bank, and property and whatever it is. And typically, most investors will come in when there's FOMO and when we see businesses growing and stable and or growing, and then just pour their money into it, which is what happened with the aggregator space. And then things didn't do so well as interest rates increased and the environment changed. Whereas most people now are probably thinking it's a bad time to buy. However, if you can get a business that has like maybe slightly up growth or even stable, and then more money comes into the market, not just on acquiring businesses, but people have more personal cash reserves across the globe where you can have more people spending, being a bit more thrifty, and you own an e-commerce business or whatever it is, those markets can grow and bring your business along with it. So yeah, it's interesting how most people might feel it's a really tough time to purchase because the interest rates are very, very high. But for example, I just acquired a real estate investment, commercial real estate investment, at a high interest rate, which I know is going to decrease as interest rates decrease, which is going to make my asset far more profitable, without me having to do anything. And it's the same with a business, that it can help that. I'm not saying it's going to absolutely happen for businesses, but yeah, what are your thoughts on that, Chris?
Yeah, I mean, I think that's a good point, because the money that individual consumers have on hand also can impact what rates advertisers are going to pay. Because if people are buying and spending more money, on consumer goods, then advertisers are willing to spend more money on ads, and that affects the ad rates that you're going to see as a publisher on your website. And so there's definitely aspects of that have an impact. I mean, I've been wrong for a couple of years now, expecting the interest rates to either stop going up or for them to decline. I kept thinking like, surely they can't keep the interest rates here because the debt that's continuing to go and the deficit spending that we see uh, is going to be a problem at some point. But it seems like now we might finally see an interest rate decline this year, but we'll see, I suppose. But I do think that, to your point, once those rates start to decline, it might help where if you've been buying when this in this tighter environment financially, that you'll be better rewarded with some of the other things improving. Now, this is of course if the interest rate cuts are bullish and the rest of the market responds well. But if maybe they're cut because something breaks, then maybe it won't be as good. So it's tough to say. I mean, I'm always kind of tough with the predictions, but yeah.
Yeah, it's definitely, and I, just as the caveat, this real estate as an example, the investment, I'm not purchasing it with the hopes. I mean, yes, it'd be great if the interest rate does go down, but I'm not going to be in a bad position if it goes up slightly as well. So covering all bases there is super important, even when you're acquiring a business. So back to the sell side, what is some of the biggest advice? Like when people come to you and like, I want to sell my business. Some people are probably ready. Some people may not be ready. What is the top sort of 2 to 3 things that you have to advise them to either get ready or have a sale go across the line?
Yeah, that's a good question. I said the most common thing is making sure that you have your financials together. It's much more common when I talk to content website owners for them not to have like a formal P&L. Whereas when I talk to e-commerce business owners, they always have them because there's just so much more work that's required with tracking cost of goods and everything else. It's just knowing the numbers is more important there than in a content site where it's like, okay, maybe 90% of your revenue comes from an advertising network. And then, you have content writers and that's like another line item on your expense. You've got hosting and that's about it, right? There's not that many, it's not that complex. But I would say that knowing your numbers and tracking those is really important. You'd be surprised. I've had scenarios where I talk to 8-figure business owners and then they think that the money they're making is like $1 million more than what ends up being. And so that's always an interesting conversation because I'm like, surely where what you're making, but you'd be surprised. So I'd say getting your financials in order is important. And the other advice would be kind of back to really timing. So if you are looking to sell right away, then there's not as much that you can do to kind of get things, improved prior to the sale. It's more about just conveying the story and sharing as much information as possible about what a new owner could do to grow it and that type of thing. But when you reach out to an advisor, or you try and plan further ahead, then there's usually a lot more that you can do. Like if it's an e-commerce business, maybe you're looking at exploring international expansion and doing that. If it's a content business and you think, okay, there's a path or uh, a direction that you can go with a new social media channel to drive new traffic and do that, then that's something you can explore. So it really kind of the advice almost always depends on the time horizon with which someone's looking to sell. And so most of the time, if it's a near term, they're looking to sell right away, which I'd say is over half the time I talk to people. Then it's more about, hey, let's try and make sure you can share the story and tell people what you think is the best path forward. When it's further ahead, then it's like there's a lot more things we can talk about. Like we're talking about, okay, I mean, there were people I was talking to that were concerned about when Google would remove third-party cookies and what that impact might have on the advertising payouts. And it's like, okay, well, do you try to sell before that, or do you not worry about it because, ultimately these advertising networks, they want to make money for publishers, and they'll figure it out, and you'll be fine even if there aren't third-party cookies. So there's a lot of those types of things that come up when you're looking much further along the line than when it's like a more near-term type path to sell, and you're kind of locked in. It's more just telling the story.
Absolutely. Yeah, the cookies one's an interesting one. It hasn't really got much light lately, with how Google has had to been forced to make changes based on other algorithms and things coming out, or search engines, I should say, coming out. And I also like to think of it as that, if they're going to remove cookies and most of their money comes from advertising, why would they not have something that's a bit more superior anyway, before it comes out? And then all these other ad networks are going to be out of business. I don't think it works like that. Personally, I could be wrong. So aside from cookies and the before somebody's ready to sell, what are some of the things you need to advise and handhold with when they're managing offers and speaking to a bunch of buyers and getting them emotionally across the line for a sale, whether it's like something they expected or didn't expect in terms of sale price? How do you manage that?
Well, I'd say it's tough. Every personality is very different with a sale, and I'd say that depending on the size of the sale, that also has an impact. I've had scenarios where I sell a business for someone that they've been running for 20 years, and so when things don't go right, it's a concern because they're going to be recognizing millions of dollars at the time of close, and so it's easy for if mistakes are made for them to get kind of heated. And so really, I just try to for the people I work with, I try and say, look, these are the things that we can control. These are the things we can control, and here's kind of where those lay out. And so, in the case of buyers, for example, we can't necessarily control whether they're going to buy or not, or can't really control whether they're going to, the path they're going to go. But we can at least say, look, here's, and this is what I do when I talk to buyers and sellers, is like, hey, here's the path that I think is the best for getting to a sale that's within the time frame that you've outlined in your letter of intent. And so it's like, we're going to start with due diligence. We're going to work on, you're going to work on the asset purchase agreement shortly after starting due diligence, so that you're not waiting for that to the very end. Because like if it's an SBA deal, for example, the APA needs to be approved by a lender. And so that can add some back and forth as well. And depending on, again, on the size of the deal, every party's attorney can be slow. I've had scenarios where like a buyer gets an APA over, and then the seller takes 4 to 5 days for the attorney to get back feedback on it. And that's just, so there's all these different things, and everyone can be different, like in terms of their timing. And so I really just try to be regimented about, hey, here's the path we've got to go to get through the business as quickly as possible, or the deal, because it's just, there's so many things that can go wrong. It's kind of almost tough to even key in on one, because there's just, every deal is different and the personalities are different. You can have scenarios where a month comes in and the month looks soft, and so a buyer's concerned because, oh, why is it soft? And so there's very much like a laser focus all the way through the numbers, all up until closing. And so I always tell sellers, look, you got to keep running the business as if the deal's not going to go through, because there's a chance it won't. And so, that's the advice I usually try to go with.
It's good advice. It's very sage advice. I mean, it's very important. I was talking about this on the podcast with another guest. It's very important that the seller doesn't end the race before they get to the finish line in terms of running the business and growing it. Because if they don't sell after a couple of months and they've just thought they've put everything into DD, you've got two big roles as like maybe the operator, the owner and the operator, and then you've also got to do your DD, um, liaising with people and sharing information and stuff like that. There's a lot to really to get through for the sale. And if it doesn't pan out like with one buyer and you've invested everything in that, then you have single source dependency on a buyer, I guess, and then you're back to the drawing board, and you might need to reverse what may have happened with no growth or little growth in the business.
Yeah. No, I mean, that's the thing, is that I have had scenarios where the seller takes for granted the buyer is making sure they want the business to do well moving forward. And I always tell people, look, you've got to run it as if the deal's not going to go through. You got to keep trying to grow the business, keep doing everything you do to keep it going well. And I had a deal where, the buyer backed out. They were too concerned about the numbers, the trajectory that happened. And then the seller was like, oh, shoot, what am I going to do? Because now the numbers are looking bad. It's like you almost have to go back and try and work on it again to grow it and get the trajectory turned back around before you can take it back to market again. Because every new buyer is going to see the same thing that one buyer that was concerned saw, which was that decline that led to them backing out. So, it's definitely a key point to focus on.
So, Chris, do you know one seller or one buyer that you've connected with that you've really seen that they've operated in a very wise way, and you've just sort of like learned a lot from them? Who were they, and why did they go through the process so well? Like, what was it? What was a part of their character that helped that really shone out for you when you worked with them?
Yeah, I mean, that's a good question. I'd say that the most common scenario with sellers that do well are usually the ones that have been running the business for a long period of time. They've thought of a lot of things they can do to grow the business. They've implemented a lot of those. They built a large business, and then they're open to the feedback that I've given. Like, hey, look, this is what we need to do. These are the concerns that a buyer's going to have. Here's how you kind of manage those concerns and do that. And so a lot of it comes back to, I think, just experience, and also personality too. I mean, that's the thing that's tough, is that some sellers rather, you work with them, and if things don't go well, then they get upset. Like I have had people get very upset at me, and also just the process. And so expectation management is important, setting that ahead of time. But I think just trying to be comfortable with the process and be willing to move forward and trying to get through. I think that's the direction. It's tough to say any one specific thing. I just think that you got to put yourself in the shoes of the buyers. Like they want a business that's going to do well. And so you got to think of it from their perspective. So as long as you can make sure you've shown that you've built something that's great and that they can take over and they have a path to go forward with it, then they should be a good transaction. When there's uncertainty, that's when you have deals that kind of can have problems and potentially be renegotiated or fall apart.
Yeah, Tony Robbins says that expectation is the thief of joy. And not that it's supposed to be a fun, super joyous experience buying or selling a business, but having an expectation really allows you to be let down. And you have to, like you said, really put yourself in the shoes of, the seller and the buyer and meet in the middle, because if you can't meet in the middle, nothing's going to happen, right? So, yeah, great wisdom from you. Thank you so much for coming on, Chris. Really appreciate the chat and answering the questions in the way you have. It's been very, very insightful for everybody, I'm sure. Where can we send people to link up with you and contact you if they need?
Yeah, I think the best is probably just my email, just chris@quietlight.com. That's the best path to reach out. But yeah, happy to be here, and thanks for the invite.
Thanks. Everybody that is listening, thank you for listening. If you're thinking about acquiring, or if you know anybody that's thinking about acquiring a business or selling a business, please do them a massive favor and share this podcast episode with them. There's so much value in it that I'm sure they're going to absolutely love. Speak to you guys on the next one.
Thanks.
Hey YouTube watcher, if you thought that video was good, you should check out this video here on the 2 best types of websites beginners should buy. Or check out my playlist on how I made my first 100K from buying websites and how to do due diligence. Check it out. It's an awesome playlist. You'll enjoy it.